Imagine a world where the value of money is tied to the value of gold. Would it bring stability or chaos? Let's explore the potential of a gold standard. Hello and welcome to my channel. Today we will be discussing a highly debated topic, the potential return to a gold standard. The idea of tying the value of money to the value of gold has been a contentious one for decades. Some argue that it would bring much needed stability to our monetary system, while others argue that it would stifle economic growth. In this video, we'll take a closer look at the potential pros and cons of a gold standard and whether it's the answer to our economic woes. So sit back and join me as we explore the potential of a gold standard. The gold standard is a monetary system in which the value of a country's currency is directly linked to a specific amount of gold. That means that a country's central bank guarantees that it will exchange its currency for a set amount of gold upon demand. The gold standard was widely used in the late 19th and early 20th centuries as a means of obtaining stability in currency exchange rates and controlling inflation. The gold standard was first implemented in the United Kingdom in 1821 and was later adopted by other countries such as the United States and France. Under the gold standard, the value of a country's currency was directly tied to the value of gold, and the money supply was directly tied to the amount of gold held by the central bank. This created a stable monetary environment by linking the money supply to a physical commodity that was not subject to the same fluctuations as paper money. However, during World War I, many countries abandoned the gold standard in order to finance the war effort by printing more money. After the war, many countries attempted to return to the gold standard, but the Great Depression of the 1930s led to further abandonment of the system. In the current global monetary system, most countries use fiat currency, which is not directly backed by any physical commodity. Instead, the value of fiat currency is determined by government fiat or decree and by supply and demand in the market. This allows for more flexibility in managing the money supply and responding to changes in the economy. However, given the historical use of the gold standard as a means of maintaining stability in currency exchange rates and controlling inflation, it is important to consider the potential drawbacks and limitations of returning to such a system. One of the main criticisms of the gold standard is that the supply of gold is finite and limited. This would constrain economic growth by not allowing for an increase in the money supply to respond to increased economic activity. The money supply is closely tied to the supply of gold and would not be able to grow at the same rate as economic activity. This would limit the ability of central banks to stimulate the economy during recessions or periods of low growth. Another reason is that under a gold standard, the money supply would be directly tied to the amount of gold held by the central bank. This would make it difficult to adjust the money supply in response to changes in the economy, such as a recession or inflation. The central bank would not be able to increase the money supply to stimulate the economy or decrease it to curb inflation, as it would be limited by the amount of gold it holds. Plus, there would be a lack of flexibility, which would make it difficult to adjust currency exchange rates in response to changes in the global economy. A country with a strong economy would have a strong currency, while a country with a weak economy would have a weak currency, making it difficult for the latter to export its goods and services. But that's not all. The rigid nature of a gold standard could lead to significant economic consequences. The gold standard also does not consider the role of central banks in managing the economy and maintaining monetary stability, as the money supply would be tied to the amount of gold held by the central bank. This would limit the ability of the central bank to use monetary policy tools like interest rates and quantitative easing to stabilize the economy. Additionally, the gold standard does not take into account the inflationary pressures of modern economies. Under the gold standard, central banks would not be able to increase the money supply to keep up with rising prices, as the money supply would be tied to the amount of gold held by the central bank. This would lead to deflationary pressures on the economy. Given these limitations, alternatives to the gold standard have been proposed and implemented. While the gold standard has been used in the past as a means of maintaining stability in currency exchange rates and controlling inflation, it is unlikely that the world will return to it given the potential drawbacks and the effectiveness of current monetary systems in supporting economic stability and growth. Alternative monetary policies and tools have been developed to achieve similar goals, and they are considered more flexible, responsive, and effective in responding to the global economy's trends. One of the main alternatives to the gold standard is the flexible exchange rate system. A flexible exchange rate system allows the value of a country's currency to fluctuate in response to market forces, without being tied to the value of any physical commodity. Under a flexible exchange rate system, the value of a country's currency is determined by supply and demand in the foreign exchange market. This allows for more flexibility in adjusting currency exchange rates in response to changes in the global economy. Another alternative is inflation targeting, where some central banks have adopted an inflation targeting monetary policy, which aims to maintain price stability by controlling inflation. This allows the central bank to adjust the money supply as needed to achieve this goal. Inflation targeting gives central banks the flexibility to adjust the money supply to respond to changes in the economy without being limited by the amount of gold held by the central bank. Monetary policy tools are also an alternative, as central banks use various monetary policy tools such as open market operations, interest rate adjustments, and quantitative easing to control the money supply and stabilize the economy. These tools allow central banks to fine-tune the money supply and interest rates to achieve economic stability and growth without being limited by a gold standard. Moreover, targeting nominal gross domestic product (NGDP) targeting is another alternative monetary policy framework which aims to stabilize the economy by targeting the growth rate of nominal gross domestic product. Under this framework, the central bank would aim to stabilize the growth rate of nominal GDP by adjusting the money supply and interest rates as needed. In addition, some central banks have implemented a combination of inflation targeting and flexible exchange rate systems. This allows them to have more control over the economy by being able to adjust the money supply and interest rates to achieve price stability and respond to changes in the global economy, while also having a flexible exchange rate system. Overall, these alternatives provide more flexibility and responsiveness to the monetary policy, allowing central banks to stabilize the economy and promote economic growth. They also allow central banks to use different tools to achieve their objectives, giving them more options to respond to the economy's needs and challenges. Well, that was all for today. The gold standard has been used in the past, however, it is unlikely that the world will return to it given the potential drawbacks and the effectiveness of current monetary systems in supporting economic stability and growth. Alternatives provide more efficient and responsive monetary policy tools that central banks can use to stabilize the economy and promote economic growth. However, if you like this video, don't forget to hit the like and subscribe button for more informative and engaging content. Thank you for watching.